All right, welcome. Today, we're going to demystify the world of stock investing. If you've ever felt like it's too complicated or just not for you, our goal here is to change that. We're going to give you a clear, simple plan to start building your financial future. So let's kick things off with a really crucial question. I want you to think about your savings right now. Is that money actually growing, or is it just treading water, trying to keep up with inflation that's quietly chipping away at its value every single day? And this right here shows you the difference perfectly. I mean, look at that. On the one side, you have the slow, steady crawl of a savings account, which, let's be honest, often doesn't even beat inflation. But on the other side, that's the stock market. Yeah, it has its ups and downs, for sure. But over the long haul, it has historically been one of the most powerful engines for building real wealth. Okay, so where do we even begin? We have to start with the why. Before we get into any of the how-tos or strategies, we need to understand the most basic building block of this whole thing. So what even is a stock? Well, it's actually really simple. It's just a tiny piece of ownership in a company. When you buy a share of a company like Apple, you're not just buying some code on a screen. No, you are literally becoming a part owner of that business. You own a tiny slice of everything: their iPhones, their brand, their future profits. It's your company too. Look, at the end of the day, investing isn't just some numbers game. It's a real strategy. It's how you make your money work for you, so it can outrun inflation, grow on its own through compounding, and let you own a piece of the companies that are literally building our future. All right, so you get the why. But now comes the big question. How in the world do you find these great companies to invest in? Well, in this section, we're going to build your first toolkit with a super simple framework for looking at any business. And this three-step framework, this is basically your map. First, and this is a big one, do you actually get what the company does? I mean, if you can't explain how it makes money in one simple sentence, it might be too complicated. Second, are the finances solid? And third, what makes it special? What's protecting it from the competition? Now that third step, that's the secret sauce. Investors have a cool name for it, a moat. And you should think of it just like a castle's defense system. For a company like Apple, their moat is that incredibly powerful brand. For NVIDIA, it's their one-of-a-kind chip technology. You want to know a quick way to spot a moat? Look for pricing power. Can a company raise its prices without everyone running for the hills? That's a sign of a really strong moat. And listen, you do not need to be an accountant to check a company's financial health. You just need to ask four simple questions. 1, is it selling more stuff this year than last year? 2, is it actually profitable? 3, is it drowning in debt? And probably the most important one, is it generating real, actual cash? Okay, and this next part is absolutely critical. I mean, you can't skip this. Finding a fantastic, world-class company is only half the battle. The other half, which is just as important, is making sure you don't pay too much to own a piece of it. You're always playing this balancing act, right? On one side of the coin, you have the quality of the business, its moats, its financial strength. But on the other side, you have its valuation. That's the price tag the market is slapping on it today. Remember, a great company bought at a terrible price can still be a bad investment. And it all boils down to this one single golden rule. Your entire goal is to figure out what you believe a company is truly worth, its intrinsic value, and then patiently wait for a chance to buy it for less than that. That gap between what it's worth and what you pay, that's your margin of safety. All right, so you know how to spot a great business, and you know how to think about its price. Now let's talk about the rules of the road. These are the smart habits that really separate long-term investors from short-term gamblers. This brings us to, the oldest rule in the book, and for good reason. You can't put all your eggs in one basket. Spreading your money across different kinds of industries, like tech, healthcare, consumer goods, is what helps protect you if one part of the economy suddenly hits a rough patch. Listen to me on this one. The market will go up and it will go down. That is an absolute guarantee. That volatility, those swings, think of it as the price you pay to get those higher long-term returns. The key is to just stay disciplined, zoom out, and keep your eyes on where you want to be in 5, 10, or even 20 years, not what happened in the last 20 minutes. So what does this all boil down to? Success in investing isn't about making brilliant, flashy predictions. It's about having a system. It's about being consistent, being diversified, actually understanding what you own, and being patient enough to let your investments do the heavy lifting for you. And hey, knowing what to do is great, but knowing what not to do, that's just as important. These are the traps you have to avoid. Don't buy into the latest hype, don't try to perfectly time the market's every move, and please don't sell in a panic just because things look a little scary. Avoiding these pitfalls is half the journey, I promise. Okay, so if everything we just talked about, finding companies, checking their health, if that sounds like, whoa, a little overwhelming, don't worry. There's a much simpler path to get started, and that's what we're covering right here. It's this amazing tool called an index fund, which often comes in a form called an ETF. Now, the idea here is so simple and powerful. Instead of trying to find that one magic needle in a haystack, you just buy the entire haystack. For example, an S&P 500 index fund lets you instantly own a tiny piece of the 500 biggest companies in the US all in one shot. So what does that really mean for you? It means you get to benefit from the overall growth of the entire economy. You're not betting on one company to succeed. You're betting on the American market as a whole. And that is a fantastic, low-stress starting point for any new investor. You see, at the end of the day, investing isn't about having a crystal ball to predict the future. Nobody can do that. It's about having the confidence to invest in the future. And with these tools and strategies, you are officially ready to get off the sidelines and begin. So the only question left is, where will you start?